Sometimes trying to really get your head around a massive industrial company like Honeywell, it can feel a bit overwhelming.
Like piecing together a giant puzzle, definitely.
Exactly. But that's what we like to do here. So today, we're doing a deep dive into Honeywell's latest numbers, their Q2 2025 financial results.
Mm.
Our goal, really, is to cut through the noise, pull out the key insights from their earnings report, the SEC filings, and just connect the dots for you, make it clear.
And it's a really fascinating picture this time. Honeywell is right there at the crossroads of these huge megatrends: automation, the future of aviation, energy transition.
Right.
So their performance gives like a great window into how a giant like this navigates those shifts, especially with CEO Vimal Kapur's big portfolio review that kicked off early last year.
Okay, let's unpack the main numbers then. Honeywell reported, pretty robust results for Q2 25.
Very solid.
Total sales hit $10.4 billion. That's an 8% reported increase and 5% organic growth.
And both those numbers actually came in above the high end of their own previous guidance.
Which is always a good sign.
It is. And what's really notable is not just hitting targets, but beating them, especially on earnings per share, the EPS.
Tell us about that.
Well, reported EPS was $2.45, but the adjusted EPS, the one analysts watch closely, hit $2.75.
Okay.
That's up 10% from last year, and again, better than they predicted. So the question becomes how they pull off such strong performance, especially when their CEO called the economy unpredictable.
Right. Good question. Well, that performance clearly boosted their confidence. They raised their full-year guidance.
It did.
So now they're expecting full-year sales between $40.8 and $41.3 billion. Organic growth now forecast at 4% to 5%.
And the adjusted EPS guidance for the whole year.
Bumped up too. Now $10.45 to $10.65. That's a 20-cent increase at the midpoint compared to before.
And connecting that back, the CEO gave a lot of credit to their accelerator operating system.
Ah, yes, the accelerator system.
Yeah, it sounds like corporate speak, but the idea is it helps them adapt quickly, drive growth faster. He also mentioned good results from pushing harder on new product innovation, which helped build up their backlog, which is apparently at a record level.
Okay, this is where, for me, it gets really interesting. Honeywell isn't just, managing the day-to-day. They are actively, almost radically reshaping the whole company.
Oh, absolutely. They've been incredibly busy with acquisitions and selling off parts of the business.
Let's talk acquisitions first.
Okay, so they closed that $2.2 billion deal for Sundyne in June. That's a big player in pumps and compressors.
Right.
Then, back in May, they announced they're buying Johnson Matthey's Catalyst Technologies business for £1.8 billion. That's a huge move into sustainable tech.
The very strategic.
Yes. Right. And then a smaller, but still important, tuck-in acquisition in July, Lion Tamer, focusing on battery safety.
Which is critical for energy storage.
Exactly. So add all that up, and since December 2023, they've announced something like $13.5 billion in acquisitions.
Wow.
Which actually puts them ahead of schedule on their 2023 Investor Day promise to deploy at least $25 billion by 2025 on things like CapEx, dividends, buybacks, and deals like these.
Okay, so that's the buying side. What about selling?
Right, the other side of the coin. They finalized the sale of their personal protective equipment, the PPE business, in May. That was a $1.3 billion deal.
And that basically wraps up that big portfolio review Vimal Kapur started, right? To simplify things.
Seems like it.
Yeah.
Though they did say they're still looking at strategic alternatives, which usually means potentially selling their productivity solutions and services, and also the warehouse and workflow solutions businesses.
So still some moving parts there, potentially.
Potentially. But the biggest move, the ultimate goal of all this shuffling, is the plan they announced back in February.
The separation plan.
Exactly. They intend to separate their automation and aerospace technologies businesses into their own independent publicly traded companies here in the U.S.
When's that planned for?
Second half of 2026 is the timeline they've given. And remember, they'd already announced plans to spin off their advanced materials business that'll be called Solstice Advanced Materials in the fourth quarter of this year, 2025.
Okay, so
if all that goes ahead, Honeywell, as we know it, splits into 3 separate, focused public companies.
That is incredibly ambitious, creating 3 distinct leaders from one integrated giant.
If a massive transformation strategy.
Okay, let's zoom in a bit now. How did the individual business segments perform in Q2? Starting with Aerospace Technologies.
Right, Aerospace, strong quarter there. Reported sales up 11%. Organic growth was 6%.
What drove that?
Mostly double-digit organic growth in defense and space, shipping more units there. And also higher organic sales in the commercial aviation aftermarket, mainly through better pricing.
Hmm.
Now, what's interesting, despite those strong sales, the profit margin in aerospace actually tightened a bit, dropped 170 basis points down to 25.5%.
Why was that?
They pointed to increased investment in R&D, developing new products for that segment. Plus, the recent acquisitions, like CAES and Civitani Systems, also played into the overall sales number, but maybe diluted margins slightly initially.
Got it. Okay, next up, industrial automation.
Industrial automation. Reported sales there were down 5%. But importantly, organic sales were flat.
So the drop was mainly the PPE sale.
Exactly. That divestiture accounts for the reported decline. If you look organically, it was flat, but there were different trends within that.
Like what?
Well, Process Solutions actually grew 1% year over year, helped by a comeback in smart energy. Sensing and safety tech was up 4%, driven by demand for healthcare sensors.
Okay, so some bright spots.
Definitely. But on the downside, warehouse and workflow solutions sales declined, and productivity solutions and services dropped 7%. They cited tough demand in Europe and also the end of a big licensing deal from early 2024.
Ah, okay. And that context helps explain why those two specific businesses are now under that strategic review we mentioned.
Precisely. It flags where the performance challenges are.
Right. Moving on to building automation, how did that segment do?
Building automation looked really good. Sales up 16% reported and a strong 8% organically. Definitely a key growth engine this quarter.
What was working well there?
It seemed pretty broad-based, actually.
Yeah.
Building products grew 9%, strong demand for fire, security, building management systems. Building solutions also up 5%, with particular strength noted in the Middle East.
And margins?
Margins looked good, too. Expanded significantly, up 90 basis points year over year, reaching 26.2%. They attributed that to volume leverage, basically selling more stuff, and benefits from the Access Solutions acquisition they made previously.
Okay, strong performance there. Finally, energy and sustainability solutions.
ESS, yeah. Sales up 15% reported and 6% organically.
What were the drivers?
A big part was UOP. That's their arm focused on refining and petrochemical tech. UOP grew 16%. Yeah, fueled by strong catalyst shipments for petrochemicals, more licensing sales in gas processing, and converting backlog on sustainability projects. Advanced material sales were up just 1%, but they were comparing against a really strong quarter last year.
Makes sense. Any impact on margins there?
Margins did contract a bit in ESS, down 110 basis points to 24.1%. They mentioned a customer settlement and cost inflation as factors, though higher volumes helped offset some of that pressure.
Okay, thanks for that segment breakdown. Now, stepping back to the consolidated sort of company-wide view, what were the main financial trends? The net sales increase, you mentioned pricing, acquisitions, volume.
Right. It was a mix of all three contributing to that overall 8% reported growth. Pricing was key to offset inflation, the acquisitions obviously added revenue, and underlying volumes were up too.
How did that flow through to costs?
Well, cost of products and services sold went up, naturally. About $0.3 billion of the increase came from the costs associated with the newly acquired businesses. Another $0.2 billion or so from higher material and labor costs, inflation still biting there.
But their gross margin.
Interestingly, the gross margin percentage held steady at 38.9%. So it suggests they were pretty effective at passing through those higher costs via pricing. Good cost management too, presumably.
Okay. What about operating expenses? R&D, SG&A?
R&D spending increased as a percentage of sales. That ties back mostly to what we discussed in aerospace, those strategic investments in new products.
Right.
Selling, general and admin expenses, SG&A, also went up, again partly due to acquisition costs, but they did mention getting some offset from productivity improvements.
Anything else notable below the operating line?
Yeah, a couple things. Other income decreased, mostly because of costs related to selling off businesses, the divestitures, and also lower income from pension plans.
Okay.
And interest expense went up. That's mainly due to higher interest rates kicking in on debt they'd issued previously.
Right. Makes sense in the current environment. But there was a positive on the tax line.
There was quite a significant one, actually. The effective tax rate dropped by 490 basis points. That's 4.9 percentage points in Q2.
What caused that?
Primarily changes in how they account for potential foreign tax issues, accruals basically. So that lower tax bill helped boost the bottom line, the net income attributable to Honeywell. That plus the higher profits from the business segments we talked about. Of course, the higher interest and divestiture costs were partial offsets.
Okay, let's pivot to financial health. Cash, debt, capital deployment. How's their balance sheet looking?
Pretty strong, actually. They ended Q2 with $10.7 billion in cash and cash equivalents, including short-term investments.
And where is that cash held?
A good chunk, $9.2 billion, is held by their non-U.S. subsidiaries. But they made a point of saying there are no major restrictions on accessing that cash, and they don't expect repatriation taxes to be a big issue for liquidity.
So good flexibility there.
Seems so. Suggests a well-managed global treasury function.
What about cash flow generation in the quarter?
Operating cash flow was $1.3 billion, which was actually down 4% from last year. Free cash flow, that's operating cash flow minus capital expenditures, was $1.0 billion, down 9%.
Why the dip there?
Primarily due to working capital changes. Specifically, accounts receivable increased because the timing of when customers paid was a bit slower in the quarter.
But their outlook for the full year.
They stuck to their guns there. Reaffirmed the full-year free cash flow guidance of $5.4 billion to $5.8 billion. So they seem confident the quarterly timing issue won't derail the full-year picture.
And how are they using their capital? We talked acquisitions, but what about returns to shareholders?
Very active on share buybacks. They repurchased $1.7 billion worth of their own stock just in Q2.
That's quite a bit.
It is. Brings the total for the first half of 2025 to $3.6 billion. So clearly following through on returning capital to shareholders alongside the M&A activity.
Which raises the question, how are they funding both big acquisitions and these large buybacks?
Good question. Their debt levels have increased. Total borrowings were up to $36.5 billion at the end of Q2, and they've also secured new credit facilities to ensure they have firepower. They mentioned a $6 billion term loan agreement, and they've already drawn down $4 billion of that. So they're leveraging the balance sheet to give them the financial flexibility needed for this big strategic transformation.
Right, balancing growth, investment, transformation, and shareholder returns. It's a complex equation.
It definitely is.
Okay, finally, let's touch on some of the legal and contingency stuff. These often highlight the complexities of running a business like Honeywell with its long history.
Absolutely. And one interesting strategic move here was what they called a liability management reorganization, which they completed in June.
What did that involve?
Basically, they allocated certain long-standing asbestos liabilities and some specific environmental liabilities, along with related assets like insurance rights, into separate, dedicated subsidiary entities.
Why do that?
You can think of it as ring-fencing these legacy issues. It petulantly makes the main operating businesses, especially the ones planned for spin-off, look cleaner and perhaps more attractive to investors by isolating these complex, long-tail liabilities.
Makes sense. So speaking of environmental liabilities, what's the status there?
Their total recorded environmental liability actually increased slightly to $755 million as of June 30th.
Okay.
However, they have that important agreement with Resideo Technologies related to the spinoff a few years back. Residio's subsidiary has to reimburse Honeywell for 90% of its spending on environmental cleanup at certain sites, up to $140 million per year.
And is that working?
Seems to be. Honeywell collected $70 million from Resideo under that agreement in the first half of 2025. So it's a significant cost mitigation mechanism for them.
What about the asbestos claims linked to the old Bendix business?
Those are still ongoing. They reported having about 4,758 unresolved claims at the end of June.
Do we know the potential cost?
Well, they mentioned the average resolution value per claim for the most serious types, mesothelioma and other cancers, was around $79,900 in 2024. But despite these ongoing claims, Honeywell maintains they don't expect the final outcome to have a material adverse effect, citing their existing reserves and insurance coverage. Okay. Any other legal matters we should be aware of? There's mention of an ongoing SEC investigation focused on some financial reporting matters. Again, Honeywell stated they don't expect it to have a material adverse impact.
Right.
And on a more positive note, they highlighted the final resolution of those older Petrobras and Uni oil bribery investigations.
Ah, yes. That was settled back in 2022 with the DOJ, SEC, and Brazilian authorities.
Correct. And just recently, in July 2025, the DOJ successfully moved for an early termination of the deferred prosecution agreement related to that, and the court dismissed the charges. So that chapter is now fully closed, which is a good outcome for them.
Removes an overhang.
Definitely. And lastly, there's still the ongoing lawsuit with FlexJet over an engine maintenance contract. FlexJet is seeking damages for repair delays. A court has ruled parts of their claim are valid, but the actual trial on coverage isn't expected until 2026, and Honeywell is appealing those earlier rulings. So that one is still in progress.
Okay, quite a lot to track there on the legal front, too.
Comes with the territory for a company of this scale in history.
So let's try to wrap this all up. We've covered a lot, strong Q2 results, beating guidance, but also this huge, ambitious plan to reshape the entire company through divestitures, acquisitions, and ultimately separation into three entities, plus navigating these complex legacy liabilities. What's the big takeaway for someone trying to understand Honeywell right now?
I think the main thing is seeing a company that isn't just managing the present well, despite economic headwinds, but is making really bold strategic bets on the future. This multi-year plan to break into three focused companies isn't just tinkering around the edges, it's a fundamental shift in identity.
Yeah, it's quite something to see them execute on strong current performance, exceeding guidance, growing backlog, while simultaneously orchestrating these massive structural changes. It really speaks to corporate agility, maybe, strategic foresight.
I think so. It's a fascinating case study in trying to do both.
Mhm.
Deliver today while fundamentally repositioning for tomorrow in a very dynamic world.
It certainly is.
And maybe that leads to a final thought, something for you, our listeners, to consider. As Honeywell transforms itself, how might the success, or perhaps the challenges of this massive portfolio overhaul ripple outwards? How could it impact the broader industries they touch, automation, aerospace, energy transition, as these new independent companies emerge?
That's a great question. Think about the potential impact on supply chains, the competitive landscape, maybe even the pace of innovation in those critical sectors. The emergence of these three potentially more focused players could really shake things up in ways we haven't even foreseen yet. Something to definitely keep an eye on.